Okay, so now we're switching gears from taxes to savings. How about that? Anyway, so in recent years, banking activities have changed quite a bit from standing in line to moved into the digital age. Whereas in the past, we would see lots of activity, people going, using ATM machines and, to get cash out or to going directly to the branch to to do their transactions, to take care of their banking needs. Now, much more has gone online and onto the smartphone for that matter. So we've gone from writing checks to using debit cards. Same thing, but it's all done electronically. Um, from depositing checks in person or by mail or using an ATM machine to doing that remotely with your smartphone again. From obtaining a bank loans from banks to borrowing from all kinds of what are called fintechs or peer-to-peer lenders. Um, Interesting times afoot within the banking industry. So when we're talking about cash management, we're really looking at short-term things that when we need cash on hand in order to make payment. When I say cash, we're saying cash or near cash, checks, again, debit cards, etc. Um, and for that matter, it could be credit cards, but again, cash in hand, if you will. So when we're buying groceries and paying rent and other activities that we would be doing again on a regular basis, meaning not regular annually, but regular daily, weekly, monthly, those type of payments that we're talking about. So things to watch out for. Um, Things to watch out for would, of course, be to make sure that you have enough cash on hand to do this and using the cash that you have rather than going into your savings account, dipping into your savings, into that what you're setting aside for emergency purposes. Using credit cards. Beyond where to the point where you're actually running balances on a monthly basis, et cetera. Just not having enough liquid asset on hand to pay your current bills, keeping up with current expenses, matching those with your current revenues, right? Um, anyway, it's managing that. This is back to that whole budgeting idea that we've been talking about as well. So differentiating, and oftentimes there's a fine line between the two is savings accounts and time deposits. Savings accounts would include like CDs, certificates of deposit, where you would be setting money aside. It's not quite as liquid as cash, for example, would be. Um, Demand deposits are again checking accounts, payments along, payment methodologies or payment services along those lines. Borrowing from borrowing for the short term or the long term, et cetera, investing in other financial services, insurance, investment, real estate purchases, tax assistance, and financial planning. These are all types of, different levels of your cash management, moving from, cash to longer term payment requirements or payment systems, if you will. So a trust is a legal agreement provides management and control of assets by one party for the benefit of another, created again through commercial banks or lawyers. Parents who want to set aside certain funds for their children's education may use a trust. Asset management account, also called cash management account or wealth management account, all purpose account offered by investment brokers and financial institutions. So there are a variety of services, financial services, again, to take care of all of your needs, short term, long term, um, and there are a variety of financial service providers that are out there to do this, if you will. So again, we've moved away from talking face to face to tellers and that human to human contact. Now we're doing much more digitally out there in the world. So we have access again for different payment transfers, deposits, and other services that are again without that human contact, where we can go online and make our payments and so on and so forth. We're to the point where we can transfer from from one smartphone to another smartphone, and tapping your smartphone and your phone rather in terms, to make a purchase, and accessing, unlimited access really to your banking accounts, to your credit union accounts, what have you, financial services. So you can deposit, your checks are deposited, directly, and online transfer from one account to another. All this is made much, much simpler, and even depositing, I say even, but it is it's a big change. It's depositing physical checks remotely using your cell phone. It's something that it's been out there a while. Nonetheless, it's something that's pretty remarkable, where 10 years ago that probably would not have been the case, or would not have been widely used, if you will. Other services, again, direct deposit transfers to savings accounts, and moving things around within your account, checking various interest rates for loans, and so much other things that are accessible now. Before, you would walk into a bank and talk to somebody about it. Now you can do pretty much all of your investing and whatnot online through your smartphone, right? Through the computer in your hand. Anyway, major changes within the financial services industry for sure. So there are a variety of services, of course, that are offered through your bank, through your financial institution. You can do all these things digitally, of course. You can use ATM machines, cash machines, whatever you want to call them. Again, using your debit card or cash card, to make purchases with your own funds through your checking account, or through your savings account too. There are ways you can access directly from your savings account in a manner that was not possible before, due to some regulatory changes, etc. But there are also, again, prepaid debit cards that are out there for people that are not, maybe don't have a bank account, or prefer not to go to the bank, or not to use credit cards. It's a way of otherwise accessing, having a prepaid debit card in your wallet. You may have $100. You can go to your grocery store, etc., and you can use whatever is on that card to pay for your groceries, etc. Opportunity cost in financial services: the higher returns for longer term savings at the cost of relatively low liquidity, meaning that you're unable to obtain your money quickly. This is the time value of money. So the longer you're separated from your money, the higher the interest rate that you would be receiving. Again, accessing funds out of an ATM, if you need to get cash, you have to be kind of cautious of that, because if you're not in the quote-unquote network, chances are you will be hit with a service fee. It can be quite expensive. Again, when we talk about checking accounts that do not have interest earning, they're no-fee checking accounts, but you have to have $500 in the checking account, either at all times or on average over a period of time. So you're missing out on interest oftentimes in that case. So changing economic conditions, they can certainly drive financial services industry. For example, interest rates are rising. Financial services, depositories, banks, credit unions, etc., would have to raise their CD rates, their certificates of deposits, in order to retain those deposits at that financial institution. So when interest rates are rising, use the long-term funds to take advantage of current low rates. That's again using the CD where there's a time that you've got to keep it on deposit in order to take advantage of those higher interest rates. Select short-term savings instrument to take advantage of higher rates when they mature so that you can access them more quickly. When interest rates are falling, use short-term loans to take advantage of lower rates. So if for example, if you have a mortgage that you're paying 5% on, for example, and say the interest rates are dropping, you might want to refinance that loan if it gets down to 4% or 3%. Select long-term saving instruments to lock in higher earnings. So if you've got a CD, you may want to lock in a 180-day CD at a higher rate if interest rates are falling, along those lines. So when we talk about financial institutions, starting with depositories, those are commercial or retail banks, the ones that we're used to, also savings and loan associations, mutual savings banks, and credit unions. The distinction, the difference between the two is what they tend to focus on. Commercial banks are just your general retail banks. Savings and loans banks are banks that are savings and loans that are focusing more on mortgages, etc. And mutual savings banks specialize in savings and mortgages as well. They are owned by the depositors, so that's owned by the folks that are actually banking at that bank. They're members of the bank. Credit unions likewise are co-ops where they are the owners of that credit union. The membership is the owner. So it's similar to mutual savings bank in that regard. But these are nonprofits, credit unions. While you wouldn't think of it, the other financial institutions that are out there are life insurance companies, investment companies, finance companies. And all three of those would fit within the framework of when we talked before about financial intermediation, the financial intermediaries. So the life insurance company, they collect premiums from people, and they pay that out when the benefits have to be paid out. Investment companies, mutual funds, similar idea. They take you take your funds and invest them for you in a variety of companies. Finance companies, again, short-term or long-term, depends upon the desire of the consumer, but they tend to be at a bit higher rates. So it's those are lending companies. Other financial institutions that don't quite fit the bill are like brokerage firms, and also credit card companies and mortgage companies. Credit card, short-term retail lending for the most part, and mortgage companies are to provide funding for customers to purchase homes. So moving away from the previous, we get into other higher rates of interest, if you will. We talk about like pawn shops and check cashing outlets. These are the territory of what are called the unbanked. People that don't have bank accounts, people that they operate kind of on the fringe, if you will, that are out there. So pawn shops, check cashing outlets where there's an enormous charge for payday loans, etc. Rent-to-own centers where you're renting appliances, you're renting furniture, etc. Can be very, very expensive. And lastly, car title loans. So those are extremely high interest rates. So all that's kind of what denotes all of these is that they're very, very high interest rates. So in selecting your financial institution, you want to identify what's most important. What features are most important to you? Services, low fees, convenience, access to online mobile operations, and pretty much all financial institutions do afford you the last piece of that mobile application, that online application, the digital access, if you will. The second step is ranking the top features based on the importance of your life situation when you're younger. versus when you're, have a family or an older consumer, your desires, your needs so far as that financial institution change. So for example, a college student, low minimum balance, for example, so that you're not hit with a lot of fees, younger, low fees, again, minimum balance, saving plans for the future, access to services along those lines, and older customers, again, there's watching out for your interest in terms of fraud detection, et cetera, things along those lines. Step 3 was prepare a list of local, national, online banks, credit unions, et cetera, that kind of fit the bill for you. And it's easy to shop for these out there, right? And it's also to keep in mind that you can quickly jump if you don't like the services that are being provided. So you conduct online and in-person research, and lastly, based on the information collected, decide where you want to do business to see what actually fits properly for you.